Welcome all. My name is Deepesh Mehta. I hope I'm audible to you and hence I'm continuing the same. Today we will be covering a major court ruling that had happened with respect to investments of NRIs into mutual funds in India. So the whole session is going to be covering on that part, and we'll try to wind up this in the next 30 minutes. We'll just focus on the key points, and I'll try to explain to you what exactly is that ruling, and if you have to take the benefit of that ruling, what you need to do. This is the whole agenda of the session. So let me get started off with this. So let me tell you a small story before I get started. So the story works in this way that a man in Italy was fined for about 500 pounds for not actually wearing a seatbelt. So he was very furious and he went to the court and then he said, "Why am I being fined?" In court, he showed this photo. In court, he showed this photo which said that he was actually wearing an t-shirt with a black stripe on it, which looked like a seat belt. So the court actually went and dismissed the fine, and the court said that the judge laughed and then said that dismiss the fine, the case is dismissed, no need to pay fine. And the reason for that is that the rule says that the driver must appear to wear a seat belt, and then that is what he did. So this is what the rule said, that the driver must appear that he's wearing like a seat belt, and this is what this driver did, and then he was not fined for this. So what's the point is that the rules are all in the details, and we'll get into some details of the ruling that income tax had. Another very good story. Two friends go to a fancy hotel. The first friend load the plate with starters, main desserts, even dry ice and everything. So he starts with starters and then he finally goes with dessert. The second friend directly starts with a gulab jamun and ice creams and then he piles them. So the second friend goes and takes the plate and then puts, multiple jamuns and then ice creams, and then mixes that and then he starts enjoying that mix of gulab jamun and ice cream. The waiter says, "Sir, you can't actually skip this main course and then just eat the dessert." This is what the waiter says, that you can't do it. But that person says that I paid to the buffet. Nowhere does it mention that I need to eat in order. Okay. So you all know that, buffet, in and buffet, dessert and ice creams are very, very expensive compared to the food. Hence, the waiter argued saying that you must be eating, you wouldn't do that. But the person says that no, that is not mentioned in the buffet, so I can eat whatever I want, not in the order of starting with soup and then ending with the dessert. So the punchline is that one line of rule, one clever interpretation, and then the outcome flips. And this is what we are going to discuss. Just like that Italian driver and then that buffet friends, a Singapore-based NRI recently turned an 1.35 crore mutual fund gain from a tax trap into a tax treaty. How? Not by avoiding the law, but by understanding it much better than the income tax. So there was an income tax law, and then this person, an Singapore-based NRI, understood that law much better than an income tax department did, and then she claimed that she's not supposed to pay any taxes on the mutual fund gains that have happened. So let's understand the background of this case. So the background is the actual person who actually did this is Anushka Sanjay Shah. She was in Singapore NRI, and she earned about 1.35 crore rupees as short-term capital gains from debt and equity mutual funds in India. And this was the year 2012. This is the year where she actually earned this kind of income from mutual funds. She claimed that being a Singapore tax resident, it should not be taxable in India. So her claim was that I stay in Singapore, so I'm not supposed to pay any taxes in India. That was her claim. And hence, she claimed complete exemption of paying taxes under the India-Singapore DTAA agreement. DTAA stands for Dual Taxation Avoidance Agreement Treaty. So basically, a country like India signs a tax treaty with another country, saying that we have this understanding between both of us, and then the treaty lays some specific rules. Hence, she this Anushka Sanjay Shah claimed an exemption under this treaty, saying that I'm not supposed to pay any tax. The department argued, saying that mutual funds are is equal to shares and hence taxable. So the IT department argument was that in India, we tax mutual funds and shares equally. So mutual funds are shares and hence taxable. She approached the court. The court for income taxes is called as ITAT, which she approached the court to go and win this argument and get a favor from the court saying that she should not be taxable. ITAT, the Income Tax Appellate Tribunal, ruled that mutual funds are trust. Remember, in India, mutual funds work in the form of a trust structure. They are not shares, and hence they are exempted from DTAA. So this is what the income tax ruled this in her favor, saying that mutual funds are trust, they're not shares, and they're exempted under DTA because the DTAA agreement says that trust should not be taxed in India. And she argued, saying that mutual fund is a trust, and hence I'm not going to go and pay any taxes because I have invested in a trust, I'm not invested in the shares. But income tax argument was mutual funds is equal to shares and they're taxable, and hence mutual funds, hence income tax lost this case because the term share is not defined in the DTAA, and further said that mutual funds are not treated as shares under the Companies Act. This was the whole argument, this was the whole judgment which the court looked at. It said that the word share is not defined in the DTAA agreement between India and Singapore, and hence mutual funds are not treated as shares under the Companies Act. With this impact, she saved a capital gain of about 20 to 40 lakh rupees as taxes. Her investment was much higher and the gains were much higher, and on that gains, she saved a tax of about approximately 20 to 40 lakh rupees. Thus, it became a landmark case and it sets a precedence for all the NRIs like you who are investing in India in mutual funds. Thus, the landmark case is called as Anushka Sanjay versus the Income Tax Department case. We'll go much further into this and we'll take questions little later. So for her, what was the breakdown? For Anushka, had it been taxed in India, in equity mutual funds, she would have been taxed 15% because at that time, short-term capital gain was 15%. So she would have paid 15% tax on a short-term capital gain, which was around 20 lakhs, 25,000 for her. For debt mutual funds, the tax was up to 30%, hence the tax was about 40 lakh rupees. So she saved this much of amount of taxes by claiming that exemption and winning this case in the court. Hence, with DT exemption, she doesn't have to pay any taxes on her capital gain tax in India. Now, we spoke about DTAA, we spoke about this case where the person who was an investor from Singapore. But the question is that what if you are an NRI from Dubai? What if you are an NRI from Kuwait? What if you are an NRI from Germany? And what if you are an NRI from US? So let us see which all countries are eligible to claim DTAA taxation exemption. So if you are actually from these countries, UAE, I read out those names: UAE, Singapore, Mauritius, Portugal, Malaysia, Oman, Qatar, Saudi, Kuwait, Bahrain, Italy, Germany, Philippines, and Nepal. And there are other few countries also. I'm just naming those countries where money flows into mutual funds at a certain scale. These investors, if you are an NRI of these countries, as per the DTAA agreement, you are not supposed to pay any capital gain taxes in India. Clear? However, if you are an NRI from these countries like UK, US, Canada, and many more, then you are supposed to pay capital gain taxes in India. So the ruling is applicable for only for these countries, and it doesn't impact for NRIs of these countries. For today, if you are an NRI from these countries. Clear? So this is how it works. And we don't know, there could be more countries also. I haven't gone and researched into it, but these are the countries where the maximum flows come to India into mutual funds. Okay. Now, why US, Canada, UK are taxed? Because the treaty between India and UK, India and US, India and Canada, it is clearly defined that mutual funds tax gains will be taxable. But however, the treaties with these countries, it explicitly does not mention that mutual funds are to be taxed. And on that basis, it's getting classified. So what NRIs, now that we understood that if you are from these countries, then you may not have to pay the capital gain taxes, but it is not just direct that because you stay in that country and then you invest in mutual funds and take out this money and then you're not taxed. There are certain steps that you need to do, and this is what this slide explains. What NRI must do to pay nil taxes in India. The first thing that you have to do is that you have to obtain something called as a tax residency certificate. So tax residency certificate is a certificate that is given by the respective country where you actually reside. So for example, if you stay in UAE, Dubai, then you have to get a TRC from the Dubai government claiming that you reside in Dubai and you are a resident of that particular country. So you have to get that. In India, you have to fill Form 15F with the Income Tax Department to claim that exemption. You have to ensure that the tax residency certificate is valid for the gain year. So I'll explain this to you a little bit in detail. A TRC is given as per the calendar year. So calendar year, let's say the calendar year is Jan 2024 to December 2024. So you go to the government of Dubai and then you ask for a TRC certificate, and then your TRC certificate is issued based on the calendar year. Okay. However, if you are withdrawing any mutual fund only in this particular tenure, only then that is applicable for exemption. So let's say you withdrew your money on 10th January 2025, though it falls in the financial year 2024-2025 as per Indian applicable law, you can't claim this exemption holding an TRC certificate for this year. So the TRC certificate is actually given as per the calendar year, and your mutual fund investments tax planning is done from in India. The financial year followed is from April to March. So you have to ensure that your TRC year and your capital gain year fall in the same calendar period. And most importantly, you have to pass the principal purpose test. It is a part of international tax rule aimed to prevent misuse of tax treaty. Just because there is a tax treaty, many people go and misuse it. Some people go and stay in that particular country and then say that I was an NRI because I was outside India for so many years and hence I need to get this tax exemption. You can't just do it in that way. There is a particular test called as principal past purpose test. It's not exactly a test, but there are some compliances that you need to follow, which will help you to ensure that you don't misuse that tax treaty and then you get exemption. So these are the 4 steps that you're supposed to do as an NRI. I'll take questions from that. I'm sure you must be having many questions. I'll take it. And then additional practical points on this. Some mutual fund companies may still deduct TDS today. In spite of this court ruling, some mutual funds still deduct TDS. If that has happened, then you may have to file for refund. There are some AMCs who may not deduct TDS. So it all depends on which AMCs you are investing. And if that AMC is deducting TDS, then you have to file for a refund. And few AMCs who are not deducted TDS, that's fine because then you don't have to pay any taxes. And a tax residency certificate costs about 25,000 rupees. For every TRC that you generate, it costs about 25,000 rupees. So this is very, very important for you to know. Let's say practically you did some redemption in November 2024, and then you also did a redemption in January 2025. In this case, you have to obtain 2 TRC, one for last calendar year and one for this calendar year. You can't club these two. You can't use one TRC to club these 2 redemptions. So you have to obtain 2 TRCs. And while you're obtaining TRCs, you also have to look at the cost benefit analysis. Let's say if you've withdrawn a very small amount and that amount capital gain is only about 10,000 rupees, and the 10,000 rupees capital gain is about 2,000 rupees, then you have to look at the cost benefit analysis to see whether it is worth asking for a TRC, or it is better to just let go and then get this tax deducted. So hence I said TRCs are as per calendar year. So you have to be very specific in actually obtaining TRCs. And more importantly, a disclaimer from our end that we are not tax advisors. So for all this thing that we are saying, this webinar has to be used more from an educational point of view. But finally, you have to consult a professional tax expert before acting upon this. Now, a basic question to all of you. There's something called as golden visa strategy. What is golden visa strategy? I'm now specifically asking with respect to UAE. Somebody can obtain a golden visa certificate strategy, which says that you could actually get a 10-year visa. And to get this 10-year visa, an investment of about 4.6 crore rupees is required in India, which is about 2 million AED. Okay, so this is what golden visa strategy is that. So now a question to all of you. So let's say wealthy Indians take UAE golden visas, stay for more than 120 days in that particular year, and then stay for more than 365 days in the preceding 4 years outside India, sell their mutual funds, and then go tax-free. Can this happen? So I'm asking this question to you. So if you could answer with an yes or no in chat box. So my question to you is that I know that I have decent amount of money invested in mutual funds in India, and I know that I want to sell these mutual funds in 2028 to use that money for some goal, like buy a house or for my fund my child's education. So I do some things where I stay outside India, become an NRI, sell my mutual funds and become tax-free. So will this work? So my question, I'm asking this question to all of you. Please put in your answers in chat boxes saying that, will this work? Will income tax allow? Just because I told these rules, will it allow? So yes, no, I need some answers. If you could actually put in some responses in your chats with a yes or with a no, then I'll give you an answer that will it work or will it not work. So we do have some responses coming in. So it should not, Rahul says it should not, and not sure, but in my mind, no. Okay, so I'll give the answers actually. So my answer to this is that it won't work, or will it work or will it not work? Completely depends on this particular thing, which is nothing but a principal purpose test. You may get a TRC, you may file an income tax form with income tax department. Your TRC is valid, but most importantly, you have to pass this PPT test, which specifically says that if you are an NRI and if you plan to claim some exemption, there has to be some reason to actually claim exemption. So let's say I decide that I go to vacations to Dubai every 6 months or every 3-4 months. I take some vacations and somehow I cross that 120-day hurdle, and then I show to income tax in India that I am an NRI, and then I claim the taxes. The income tax will not allow, because it looks for a reason for me to actually go and reside outside India. Have I gone for employment? Do I have some do I have some structured business there that I need to regularly visit, or I went directly to went outside India so that I saved I save a significant amount of taxes in my mutual fund withdrawal. Hence, this particular test has to be passed before you actually claim the exemption. So this is what I wanted to convey using this example. Now, 1 minute, I'll just reshare this screen again. Just a minute. 1 minute. Okay. So I share my screen again here. Oh, sorry. Okay. Just a minute. So hope you can see the screen again. Yeah. Okay. So some other pointers to note. These are some general discussions that are happening around this. Some or other view, I spoke to many chartered accountants and asked their opinion, and this is what I came to know. As per the ITAT, as the ITAT has ruled out provisions in capital gains arising from sale of mutual funds units to an individual NRI may not be applicable in general till this is notified by income tax authority. Please remember, only the court has did the ruling, but the income tax has not notified about this, that under the particular section that exemption can be claimed and it becomes tax free. And chartered accountant are of the view that income tax authority may go to Supreme Court to challenge this decision. Hence, ITAT decision is not final. So, to be honest, we are at the gray area. So the ITAT says that you can claim exemption, and there's a landmark case that could be set as an example and as a precedent. But tomorrow, in case if income tax authorities approach Supreme Court and then win over this case, then this income tax gains that we are talking about may again be taxed. In respect to mutual funds, some mutual fund companies have a process of tagging NRI customers from different countries along with the DTAA status. So what mutual fund companies have done is that they have tagged, an investor as per the DTAA agreements. So these countries which I mentioned fall under a different bucket, and in the other countries which I mentioned, like US, UK, and Canada, fall under different buckets. So mutual fund companies have actually tagged it accordingly to the respect where they have to deduct TDS, where they shouldn't be deducting TDS. Once a tax residency certificate is obtained from the investor, the same is updated in the mutual fund system. So you have to collect a TRC from the respective host country where you reside and then submit it to the mutual fund companies. And if you fall in those specific countries, some mutual fund companies will not deduct, the rest will deduct the TDS. On successful updating of the TRC in the system, TDS is not deducted for NRIs from specific countries in which India has sent it. So I'll tell you two scenarios. One scenario, you reside in Dubai, and then the mutual fund know that you reside in Dubai, you apply for a redemption, but you don't give a TRC certificate, the TDS will be deducted. Another scenario, you reside in Dubai and you go and you upload this TRC to the mutual fund portal or submit this to the mutual fund companies. And once when they have synced that data with your folio, only at that time they will not deduct the TDS. So all the dots have to be connected to ensure that the TDS has to not to be deducted. Okay. So this is then from one mutual fund company, that's Quantum Mutual Fund. They have explicitly given this on their website. So they have said that from which countries they will the gains or taxes and under what provision. So I'll read out some things. From US, they say under Article 13, it is taxable in India. In UAE, under Article 13 of 5, it's not taxable in India. So they have given the reason for this also. Like in Singapore also, they have mentioned it's not taxable in India subject to limitation of relief. So they have clearly mentioned that as per the recent judgment issued by ITAT, it's not taxable. So some mutual fund companies have taken one step ahead and told that we will deduct TDS for these countries, will not deduct TDS for these countries because it is not taxable as per the agreements. So you could see this in Singapore. So they are also for Qatar. See, like I'm just highlighting this thing that I know they have given with the proper clause treaty name. So in case if any of your chartered accountant needs help, so you could actually ask them to refer this so that they get an idea of this. So they have mentioned like Qatar, it's not taxable, Hong Kong is taxable, Australia is taxable, Malaysia not taxable, Canada taxable, Germany not taxable. So this is how mutual fund companies have classified because for a mutual fund, money comes from different NRIs, and so they have classified it. Italy not taxable, Philippines not taxable, Nepal not taxable. And then what happens if gains are tax-free in those for those countries NRIs? So really assume that if Supreme Income Tax does not go to Supreme Court and then they keep accepting TRCs and then keep claiming exemptions, or mutual income tax lose this case in Supreme Court in case if they go approach Supreme Court and then it is favored in favor of the NRIs, then what happens? That then it clarifies that then mutual funds are not shares. That's first clarification. It will encourage NRIs to invest more in mutual funds. It's likely to boost Indian mutual fund industry AUM, and eventually it's going to even boost the capital markets at a bigger picture. So this is what's going to happen. So the summary and recommendation is that check if your country has favorable DTA with India. We have participants from different countries, so we have to check whether, for example, if you are from South Africa, so I haven't checked it, so you have to go and check whether this is there in that your country with India or not. Get TRC, fill form 10F, time exits carefully. This is very important. So let's say you obtained an TRC for 2024-2025. and you need money in February 2026, then you actually, since you have obtained an TRC for 25 for this calendar year 2025, please ensure that you also redeem in 2025 itself, so that your timing of exit and then the TRC validity is coincides in the same year. Most importantly, consult tax advisors and stay updated for any rule changes. So this is what it is. What currently we are doing, because this is a very gray area. Like we at Happy Investor, we have significant NRIs investing outside India, and they are investing in mutual funds in India. So what we are telling them, that if you are actually planning for a redemption, and we don't know whether tomorrow, in case if Supreme Courts will favor the NRIs or income tax bill, when we don't know about it, what we are saying is that whatever tax that you are supposed to pay, please park the tax amount into some mutual fund schemes, and don't spend that money for whatever reason that you are withdrawing that money. Please park that money aside till a clarity comes, because tomorrow, in case if you are asked to pay that money, then the income tax will again come back to you asking you to pay that money for old dues. So please park that money maybe in an liquid fund and some debt funds till some clarity emerges. This is what we are advising. That's it, and this is about Happy Investor. Some of you are not, clients of Happy Investor who have been joined. So this is just an introduction of what we do. So we are a team of 10 people now. We are operating from Bangalore, India, and we have about 82 years of experience. A very senior team aligned to create wealth. Our work has been featured in Times of India, Outlook, Money Mill. I have also published a book, which is I have also authored a book which is published by CNBC TV18. Is about us. And that's it. Thank you so much. Or to you, all of you, for any questions. As I promised, we'll be completing this webinar in 30 minutes. So we are on time. So happy to take any questions from any of you. Yeah, you can unmute yourself and so Dr. Celso, you're asking, have you got a copy of TRC from any country before? So Dr. Celso, I have not personally got, but TRC is not only required. TRC, the purpose of TRC is not only for mutual funds. There are multiple uses of TRC. So TRC is required for other various reasons as well. So yes, it's possible to get it. It's not that a document which is a hard document that is not available. So it's possible to get. But if you ask me, have I got? No, there was no reason for my clients to actually get this from an mutual funds point of view.
Dipesh, I
Yeah.
have a question. Okay.
Yeah.
So how they consider NRI or non-NRI on the basis of the KYC or on the basis how I made the payment? Like
So
for
it
my
is.
case, I made the payment from saving account, but it's updated as a NRI in my case.
So when you make your investment, the investment could you would have made the investment from a savings account at that time. You were a resident Indian,
Yeah.
and then you updated your KYC status as NRI status.
Hmm.
So at the time of redemption, whatever is your KYC status, whether it is resident Indian or non-resident Indian, accordingly it is tagged. So you could be a resident Indian. In your case, you were a resident Indian when you invested, and then for job you moved outside India. Hence, we help you to change your KYC, and now you apply for redemption. You will be tagged as an NRI itself, and not as a resident. It doesn't matter when you made your investment. What matters is at the time
Okay.
of redeeming, what is your KYC status.
Okay, so like for example, today I am in Singapore. Okay,
Hmm.
for example, next year I move to India, but I don't redeem. Okay, I
Hmm.
redeem my amount after 5 years. That time my residential status would be a non NRI, right? So that time
Yes.
tax will be implemented there, right?
Yes. Yes.
So
Yes.
better case when I am relocating back to India, I should
Ah.
redeem all my amount and I should reinvest the same amount via Indian residency, right?
Yes,
To save the
yes.
tax.
Ideally, basically, what you are saying is do a tax harvesting, so you don't pay tax, and then again reinvest this once you are back in India.
Right.
However, However, that is how you should not be looking at it, because we are still in that gray area, and we
No,
don't know
for the
whether
safety side, I'm talking for
for
the
the
safety
safety
side.
side.
Of course,
Yes,
I
yeah,
will
yes,
save.
yes,
I'm
yes,
just
yes.
saving 30% tax for some the long term capital gain. I'm just
12 and
saving
a half
that for the
percent.
time
12
being
and a half
only.
percent. Yes,
Yeah.
yes,
In
yes.
case if they implemented the same rule, then I have saved my tax. I can pay it again, right?
Yes, yes,
It's just for
yes,
the
yeah,
safety side.
yes. You can do it. You can do it. You can do it. Yes. Girish is asking, will the recording be shared? Yes, Girish, we will be shared. We'll be sharing this recording. We'll be sharing this recording. Yes. Okay.
And Divesh,
Any other questions? Yeah.
any way like where we can get the clear picture. Are they trying to change the rule? Are they trying to claim in the Supreme
We
Court?
we will we will keep you updated, Tarun. We are on this. This is our job. So any judgment that comes, we will notify you. You are associated with Happy Investor, so you will be the first person who will get the communication from our end on this.
Okay, okay. Thank you so much.
Thank you. Yeah. Okay. Any other questions? Okay. So since there are no questions, so we will be ending this webinar. So thank you so much. Thank you for joining us, and we will also upload this webinar on our YouTube channel as well. Maybe in the next 24 hours, if you check Happy Investor Finserv in our YouTube channel, you'll be seeing the recording of this webinar. You can also share this to others as well. Thank you so much. It was great talking to all of you, and I end this webinar. Thank you for your time.